Today we will cover how the digital banking technology is different than the legacy banking system. We have created 6 areas where the digital bank has a differentiation from a legacy system. And these 6 are customer segment, digital product, channels, technology, regulation, and risk management. Now, we have already covered the 3 areas, which is more of a customer segment, digital products, and channels. You can find these 3 videos from my channels, which can explain you how digital segment is different than actually legacy banks in a digital banking or online banking or virtual banking, whatever you can call it. And digital products is also different because they are not having a branch banking. So it is mainly on a virtual basis. So how it is different too. And channels are almost the similar except the branch banking, and how they are doing differently to get the benefit of the customer segment which they have created the digital bank. Now, today we are covering the technology. Digital banking technology is slightly different than the normal legacy banks difference. One of the big difference is that digital banking or virtual banking is all about retail banking, not the corporate banking. However, in a digital banking, SME can be seen as a corporate banking, but actually SME need is very different. So as a retail banking, digital bank is very different than actually normal bank. And as I said before, that legacy banks are having a multiple types of banking, which is not in a virtual banking. One is like not only the corporate bank, they have a private banking, they have a personal banking, they have a treasury, they have a trade, they have a bonds selling, and a lot of other like products which is not for a common people. And virtual banking or digital banking is for common people. So when we are going in a technology and putting up a structure or architecture, which is the ultimate target for us, that we have to put a architect for both hardware side and software and solutioning side. But I cannot be able to do it in a one go. So I divided into the 4 areas. One is define your digital need. Second is selection criteria for core banking solution. Third is identifying upstream and downstream. And fourth is digital bank architect. Defining your digital bank is all about the functional specification of your digital bank. Means you have to define your niche, you have to define your customer segment, and when you have already defined your segment, you have to design the products, service, and processes, that how this can be converted into the functional specification. So today we will only cover the define your digital bank. Now, today's topic is more of a define your bank. Means that what are the 4 areas we have to cover when we are defining the bank. Means that why we are creating this digital bank, what segment we are targeting for, and what product services we want to give it to our customer, how much we will go from step by step to increase our revenue, when we can be able to profitable. All these things has to be discussed as a strategy when you are putting up a digital bank. And when you are discussing all these 4 things are very, very important. The first thing is, identify your geography. That is very, very important, because some of the areas in the world is penetration of the digital is very low, and some of the areas where the penetration is very high. So if you will take an example of uh, Pakistan, Bangladesh, India, Africa, Middle East, the penetration of the mobile phone is less. And same as in these areas, you can find the digital inclusion is also low. It's not only the digital financial inclusion is low, but people are having a less account number. So this is something that when you are targeting about Vietnam, Indonesia, Thailand, maybe it's different. And when you are going to the UK and trying to define your geography, or Europe, it is very different. UK, let's take the example where it is a pretty mature from a geography perspective, same as it is pretty mature from a digital or virtual banks basis. Products, services are well established in the last many years. So what we look into banks over there like Atom Bank, Starling Bank, N26, Monzo, or Revolut, all these banks are basically well established in the last 10 years. So first thing is that they are trying to establish this in the last 10 years. So it's not a few years. So they learn from the passage of time that what services works, what product works, and how we have to go for. So this is very, very important then that we have to understand that what geography you are in. And when you are going in a geography and you have established your geography first, because you can be a multi-country. So it can be a one country, which is UK only, or you can go like N26 or Revolut, which are having somewhere around 20 to 26 countries across the Europe. So I will discuss more when I am talking about the regulations, but here you have to define that either today you want to have in a one country or two country, but in future, do you have plan in a 5 years or 10 years to move into the other countries? Because it's much easier for a digital bank to go to the other countries because there is no infrastructure, and mostly the digital banks are on a cloud. So replication of the countries is much easier, in fact. Now, the second item is identify your competition. So as I said, that if it is going and we are opening a bank in Europe, might be it is very easy to do that. But when you know that competition, you know that what banks are around, 40-50 banks are there. In fact, there are some payment solution like PayPal or Wise and others also become the bank kind of, although they are not getting the license. So when you are going into the mature market, your competition to work out is slightly different than when you are going to the market which is just starting the digital or the virtual bank. So you have to define yourself. Only competition you can see with the legacy bank. So legacy bank also in the last 5 years did a lot of digitization in the bank. So especially from a customer perspective, like most of the banks are having a app. It can be a very basic app to a very super app kind of services. So banks are moving the legacy bank into the digital transformation and digital kind of enable bank. They call it how we can be digitally enabled bank. Means that although we are providing the service which is more of a brick and mortars, but we are providing the services which is more of a digital. So they have converted a lot of products which are from a legacy to the digital way of products. I can give you the one example and you can understand. I was working as a chief digital officer for a few years to the Faisal Bank. And we took the initiative not only to go to the digital enabled bank, but also creating a super app. And thereafter, we have to introduce few products which are purely digital products. And one of the product is like for freelancer. So it's a very kind of wallet account. It's not a wallet, but it is kind of wallet account, very low size of the account and very low need of the KYC as per the regulations. And these freelancers can open an account, and then we use the open APIs of Payoneer and connected with them and provided through an app API to screen that how people can open an account over there of a Payoneer. So they can open an account with the Payoneer, they can open an account with the bank, and then they can link it to. And we agreed with Payoneer to fund this account, which we are having with the bank, should be pre-funded account. Because it is conversion of dollar to rupee was involved. So actually, when somebody is trying to transfer $200 or $500 from a Payoneer account to their own account, it's just a matter of 10-second job. So this is something that you can define your lot of products which are mainly, like one of the example I can give you is spend now, pay later. This is a very good product for the digital banks, and a lot of digital banks are providing it too, and a lot of people are ready to take it. I mean, it is why they are very much looking forward and doing sort of a transaction digitally, and as well as using the credit card. So when they are paying later, in fact, it is possible that they can buy through e-commerce and can be able to pay later. So you have to keep understanding that what kind of products you can be able to create, which are purely for the youngster, purely for the people who are unbanked, only the people which are not getting the opportunity to take the loan or have a lending, same as in case of SME as well. Now coming into the product and services, the third point is product and services. So some I have already spoken in a competition when you are differentiating yourself to the product and services. The product and services is also different. Why? Because like if there is a legacy bank, the minimum credit card types are 7 to 10. Some are having a 15 types of cards. Although all the time they try to reduce the number of cards and try to amalgamate the need, but actually it is not possible. Like few people are using the credit card for travelers. These are the people who are frequently traveling and they need kind of traveling points on it. The people who are basically using the credit card for shopping, they need some points for the shopping. The people, even the ladies which doing the grocery and going for their own shopping, there is a ladies card as well in place. So there is a student card is there. Now, digital bank cannot come up with so many credit card because a lot of work is required, and the legacy bank did it in a passage of time of 15-20 years. But you have to define the customer segment you have, what kind of 3 to 4 type of cards you can be able to give it to. And when you are giving this card, you can see what value you can give it to them. Like it can be a MasterCard, it can be a Union Pay, it can be Visa, whichever the affiliation you can get it. In case of debit card, you are looking forward that what kind of debit card you are giving, whether it will be worked in one country or it will be working in other countries. It is the MasterCard logo, which can use a 25,000 ATMs across the world. So all this, when you are going for a product and services, so product is a product and channels, and service is a service on those for those product and channels. And the service also comes into the what kind of rate, conversion rate you want if somebody is transferring the fund from one country to another country. What kind of interest rate you are paying it to the people when somebody is keeping the personal account in the digital bank. What kind of interest rate you are charging to the people for overdraft, or you are giving a kind of loan or doing a lending to the consumer, or you can having some of the product for SME where you are giving the loans to the SME customers. So this is the something that you can be able to create. And if you are starting a digital bank, you have to take the I call it staircase strategy. So there are two strategy. One is a staircase strategy. One is lift strategy. So if we want to go to the 40th floor, so we can go in a lift and we can go to the 40th floor. But if we are having a staircase strategy, we have to go step by step. And the digital bank specifically is a staircase strategy. Why? Because the local regulations usually is that you have to increase the capital in the next 5 to 10 years. So every year you have to increase the capital, and you have to give your roadmap for 5 years, that how you can be able to introduce the new products and how you can be able to grow. So it is basically that you have to start thin. And what I want to say is you have to start thin. What is the meaning of thin? Meaning of thin is that you can have a deposit. Mainly is it can be a personal account, it can be a saving account, and you can have a various variation of that. And second is you can be having a lending, where you can be able to have a very few products for your segment. Then you are having a payment, and payment is basically that how people can be able to pay or transfer from you. And fourth is that you have to think about spending and how much the data you can be able to provide to the people, that they can be able to understand their spending. Now, what legacy bank usually don't do, or you can find a very less on a legacy bank, that they are giving a lot of information to the customer on their spending. But in digital bank, it is available. Like I can ask to my digital bank, what is my spending on a petrol? And I know that. What is my spending on a restaurant? I know that. So you have to define this fourth element as well. And this is called your product and services. And you have to create a processing around it. The last one, or fourth one, is called understanding of a regulation. Now, there are multiple regulations for legacy banks as well, and digital or virtual bank as well. So it is not very different. Like maybe capital for a bank is different, because a legacy bank is coming from a, say, 30 years, 50 years, or 100 years. Their capital requirement is very different than a digital bank requirement. So your capital requirement can go up on every year for the next 5 years, and then moving forward, capital has to be increased. Now, when you go to like anti-money laundering kind of regulation, it's same. You have to implement the solution which can be able to do the transaction monitoring. They have to do the process monitoring. They have to do the credit profile monitoring. And also, they should be going for a certain other monitoring, like sanction monitoring, like PIP monitoring, like politically influenced people, and also some of the blacklist people you have to monitor. So you have a number of things under the anti-money laundering where you have to do, and it is not that only the regulation you have to comply with, but actually it is good for you as a bank as well, because the lot of frauds has happened. And when any new bank, see, very carefully listen to me on this subject if you are going for a new bank. Lot of this scammer go for those banks which just started. So when you are started kind of hard-hearted, half-hearted way, the scammer can be very, very successful. And you can gone in a development of a new bank and started getting some losses in the bank. So this is something that you should understand, that especially the regulatory monitorings are very, very important. The second area on a regulatory monitoring is the regulators. So regulator is asking a lot of regulatory requirement, even for a retail banking. The most common is your secrets, which is a more of a credit basis, means that if you are giving any loan to the person, you have to inform, you are changing the limit of any person on this lending or working capital for the SME, or you are opening a new account for the saving or personal account. All this has to go every day. So if I have created an account, today bank has created an account for a customer on a saving account and set a interest rate something, and tomorrow you find that, oh, this interest rate has gone wrong somehow or another because of the bug or whatever it is, you can change it. But when you are changing it, this change has to go to the next report as well in a secret. So everything you do and change has to go to the regulator, and the regulator is having a very defined and well-established monitoring system, and they can track your error very easily. So I used to do, in fact, in a Standard Chartered Bank, I worked for 28 years in a Standard Chartered Bank. What I did is, I asked the vendor who developed this for the regulator to give this query solution to us as well. So every day when we are sending the report to the bank regulator, we are running those queries on it, and we know the error first before it should go to the regulators. And the reason behind is that why we want to do it, this is the penalty area. So banks are getting millions and millions of dollars every month if they are making mistakes. So maybe for an early stage, any regulator will be able to give you some leverage on the errors and try to give enough time to basically do it right. But whatever you want to do it, you have to do it right. The one reason is that to overcome is not easy. In a legacy bank, we have all these processes in place, where in a digital bank, it is not there. So I can give you the example of it. Like whether it is a product or whether it is a regulation, we are having hundreds of pages process. In a product, we call it PPG, which can be 60 pages, 80 pages, which is define exactly A to Z the product. So each product, there is a product owner in the bank. My digital bank cannot have it. So my digital bank can have a one top product manager and maybe one or two assistants. So with the less number of people, but the work remains same. So if you want to do the saving account PPG, you have to work and fill these 100 pages. You cannot hire a person from a legacy bank, and if he bring this sort of even the PPG or the process manuals, it will not work in a digital bank. I'm telling you, the mindset and the systems are very different in the digital bank. Might a person who is coming from a legacy to the digital bank and having enough understanding of the digital bank and having enough knowledge that how digital bank can be run, and did some study and established some of the digital bank, it might can work. So you have to fill all these 100 pages. So not only on a product and services, but on regulation, when you are going to do the credit monitoring, so you have to put, or credit scoring, you have to have a complete process manual for a credit scoring. And so same as if you are going for each customer's credit profile, you have to have a complete process for the this profile, credit profile. We will discuss more on upstream and downstream when we'll come to the third section of this digital banking technology and solutions. But here I want to say that RegTech, or you call it regulatory technology, has to be used. And because these digital or the virtual banks are mainly into the cloud, and the solution, and mostly are on a SaaS basis as well, or PaaS or SaaS, in fact, in a combination of it. But if it is SaaS, you have to utilize the right solution for these RegTech solutions. So we will cover later on these things. But today, I just want to cover that if you are defining your bank as a first time, what are the basics that you have to look into to set the strategy. At the end, when we will finish this technology and regulatory and risk, I talk to you the 6 areas which I have to cover. I will go and build the strategy of ABC Bank. I did it. I did it for the 2 banks to set up the pure digital bank strategy. I was one of the consortium designated CEO for a bank in Malaysia when they were going for a licensing. And I have helped many banks in multiple countries to set the your strategy right. Now, there are so many consultants I work with, McKinsey or any other consultant. These consultants are usually put the strategy on the basis of multiple experiences in other countries. So it is having advantage and disadvantage as well. The advantage is, you know what was not working over there, and you can be able to set the strategy right. But you lose something, that when you are going for a strategy, you lose the local focus, the local segmentation you have, local behavior of the customer, what you have. So this is something that it's not a hard and fast rule. What is the right way to set the strategy? But I believe it that you should be having some consultant or be having some senior people who should be able to help you when you are setting the bank. Thank you very much. If you like this video, please subscribe it and press the bell icon so that whatever I'm covering thereafter on a digital bank, you can be able to do comment. If you don't agree with me on anything, please write down in a comment. If you feel that you want to add anything, please write down in a comment as well, because this is a value to the people.